In the third question, we consider the tax implication on the difference between yields on bonds. Let's consider this investor who's in a 35% marginal tax bracket. That means for every dollar this investor earns, he or she has to pay 35 cents to the federal government. That's the federal income tax. Now, this investor currently kind of investing in a U.S. Treasury bond. For every $1,000 par, he can receive an annual interest income of $85. That means this U.S. Treasury bond pays 8.5% coupon rate. The question basically asks you, suppose you have a Muni with the same default risk and the same maturity as this Treasury bond we were talking about. What kind of coupon rate this Muni should offer so that this investor will be indifferent between investing in either bonds, right? He should receive the same amount of income, after-tax income from either bonds, either the U.S. Treasury bond or the Muni. Let's look at a basic relationship here. On the Treasury bond, the investor has to pay income tax. So what he will receive is basically this taxable yield times 1 minus the tax rate. That is the after-tax yield, right? For this Muni, as long as the Muni can provide a so-called taxable equivalent yield to this Treasury bond, then this Muni will kind of be the same, right? Generate the same amount of every year, after-tax interest income every year. Okay, and that is basically the yield on the tax-exempt bond. Why is that? Because on this tax-exempt bond, the investor does not have to pay federal income tax. Okay, the calculation here is not about the yield, though. The calculation here is only just about the basically the coupon rate or the interest income. So what we have is that the taxable interest income is $85. On that, the investor need to pay 35% of tax. So times 1 minus 35%. That equals, well, 85 times what? Times 65%. That's after-tax income, right? And that amount is, let's do the calculation here, 85 times 0.65, that is 55.25 cents. So that equals, well, $55.25. So that's our answer basically. As long as this Muni can offer $55.25 to this investor, this investor will be indifferent between either investing in the U.S. Treasury bond or this Muni. In other words, as long as this Muni can offer a 5.525% coupon rate, it is equivalent for this U.S. Treasury bond that offers 8.5% coupon rate to this particular investor.